welcome to this explainer. Today, we're launching a full-blown financial investigation into H&R Real Estate Investment Trust. We're trying to answer one absolutely crucial question. Is this stock a deep value opportunity, or is it a value trap in disguise? We're going to examine the evidence, run the numbers, and try to piece together the puzzle of a trust that's, well, clearly in the middle of a massive transition.
Okay, let's dive into this, because that right there is the multi-million-dollar question at the heart of our investigation today. You see, H&R REIT is currently trading at a really steep discount, and on the surface, that looks incredibly tempting. But as any seasoned investor knows, a cheap price tag doesn't always mean a good deal. We need to figure out if this massive discount is a true margin of safety or just the bait in a value trap that's about to spring on us.
To get to the bottom of this, here's our agenda. We'll start with 1, business and intrinsic value. Then move to 2, deep dive fundamental analysis. 3, SWOT and scenario analysis. 4, target buy and sell prices. 5, risk and opportunity scores. And finally, 6, final verdict and takeaways. Don't worry, we have a methodical plan to digest all the heavy metrics ahead.
All right, Section 1, business and intrinsic value. Let's step right into the interrogation room where we first meet our suspect and look at their baseline stats. So what exactly does H&R REIT do? Well, they operate across 3 main areas: office, retail, and residential properties. Now, the good news is their revenue is surprisingly stable at roughly 815 million Canadian dollars, and that's largely supported by multi-year long-term leases that give them pretty predictable cash flow. But the bad news, they're facing massive structural challenges, particularly in their office portfolio, mostly driven by the whole shift to remote work. Because of this, their assets are shrinking under the weight of some incredibly heavy write-downs. So the business itself is understandable, but it is deeply, deeply in transition. Now, what's really interesting about this slide is the sheer contrast in these valuation metrics. It's wild. The trust is currently trading at 1060, which represents a massive 32% discount to its net asset value of 1563 per unit. That NAV discount is exactly why this stock looks like such a bargain. But look a little further down at that estimated funds from operations, or FFO, fair value of just 1.08. That is deeply concerning. Traditional metrics like PE and PEG, they aren't even meaningful here because of all the massive non-cash distortions. Moving on to Section 2, deep dive fundamental analysis. It's time to dig into the raw evidence and uncover exactly where the bodies are buried in this balance sheet. As we scan the financials, the red flags just light up the board. We're seeing declining adjusted funds from operations, which is essentially negative once you account for capital expenditures. Then we have these massive, unusual item write-downs exceeding 998 million Canadian dollars. That's almost $1 billion. It's a glaring signal that the economic value of their properties, especially the office ones, is plummeting. Add to that weak FFO growth, a dividend that's looking really strained, and incredibly high sector risk from the structural decline in office space, and yeah, our suspect is looking very shaky right now. This right here is the true paradox of H&R REIT. On one side of the ledger, you've got this very stable $815 million in revenue and a positive operating cash flow of $188 million. That gives them some short-term breathing room. But on the exact opposite side, a devastating $791 million net loss. And to make matters worse, their total assets have literally plummeted from over $21 billion down to about $9 billion. That is a staggering destruction of shareholder value, all reflecting intense asset sales and aggressive revaluations.
Section 3, SWOT and scenario analysis. Let's transition from just staring at raw numbers to actually organizing our clues, moving from raw data to strategic deduction.
Okay, so in our weighted SWOT analysis, the highest score goes to that massive NAV discount, which scores a solid 7. But as you can see, it's heavily dragged down by weak FFO, intense sector risk, and those terrifying asset write-downs, which only manage a score of 2. When you factor in the weights of each individual component, we end up with a pretty mediocre total score of just 4.3 out of 10. The fundamental weaknesses of the business are just seriously dragging down any valuation perks.
Let's move to Colatoon and see how this builds across 3 potential futures for the REIT, all of which depend entirely on how well management actually executes. In our bear case, the worst-case scenario, FFO declines further, NAV drops another 20%, and the resulting value crashes to somewhere between 6 and 8. In the base case, where things basically just stabilize, value sits between 9 and 11.
But in the bull case, if management actually pulls off this repositioning away from office space and doubles the FFO, we could be looking at a value between 12 and 15.
All right, Section 4, Target Buy and Sell Prices. It's time for the hard math, anchoring our investigation to specific numbers and concrete targets. The core assumption of our financial model here is aiming for a 9% average return per year over a 16-year horizon. If you hit that, you're looking at a 300% total profit. Now, notice the direct relationship on this table. The higher the return you demand to compensate for taking on this risk, the lower your entry price absolutely must be. Specifically, to hit that 9% target over 16 years, you cannot pay more than $9.80 per unit. Anything above that, and honestly, the math simply breaks down.
But what if your timeline is a bit shorter? Well, if you're looking at, say, a 5-year horizon, you can actually afford a slightly higher entry point of around $12.50 to hit that exact same 9% return target. But keep in mind, a shorter horizon with a business undergoing a messy, multi-year restructuring is incredibly risky. If you're going to stick to a longer horizon, it demands very strict discipline on your entry price.
Every good investigation needs an exit strategy, right? So here it is. If the repositioning works and the price climbs, you start trimming your position between $13 and $15 and execute a full exit if it pushes above 16. However, and please hear this massive warning, if the net asset value declines any further, it totally invalidates the entire investment thesis. If that happens, you exit immediately. Period. No questions asked.
Section 5, Risk and Opportunity Scores. We're getting close to the end of our investigation now. Let's weigh the final calculated metrics before delivering the ultimate verdict. First up, the risk score comes in at 5.2 out of 10. This signals a moderate to high risk profile. Why? Because the uncertainty around their actual assets is intense, their macro sensitivity to interest rates is super high, and their cash earnings are deeply, deeply weak. On the flip side, the opportunity score sits at 5.8 out of 10. So the crucial point is this. There absolutely is moderate upside here, but it's entirely reliant on that NAV discount holding true. That upside is severely limited by the weak underlying fundamentals of the business itself. Finally, Section 6, Final Verdict and Takeaways. We've reviewed the balance sheet, weighed the risks, run the scenarios, and calculated the exact entry points. It's time to answer our initial mystery. You know, the contrast between these two investing legends perfectly captures the exact conflict at the heart of this setup. A value hunter like Peter Lynch might look at this and see a classic turnaround story in the asset repositioning. But a quality-focused investor like Charlie Munger, he'd likely look at the weak underlying economics, the structural decline of office spaces, and just walk right past it. So here is the final takeaway. Our verdict is a hold leaning cautious. Look, this is not a stable income vehicle for a defensive dividend portfolio. It is a complex restructuring story. Because the intrinsic value is so clouded by those massive write-downs, patience is completely mandatory. If you do want to invest, it only makes mathematical sense if you can secure an entry price below $9.80. That is the only way to ensure a true margin of safety. And that wraps up our investigation into H&R REIT. Ultimately, you have to ask yourself, are you willing to catch a falling knife if the discount is deep enough, or is peace of mind worth paying a premium elsewhere? The math definitely says caution, but hey, the choice is yours. So, which stock do you want me to put under the microscope next? Let me know your top picks in the comments below, and we'll launch our next explainer soon. Keep learning and stay disciplined out there.